Well, if we really had no inflation, gold would not be doing this. Silver would not be doing this. So these are real world market indicators that there's a problem here, and that is inflation. These are inflation hedges. These precious metals are very sensitive to inflation expectation. People expect more inflation, they buy more gold and silver. So that's people voting with their feet, right? They're walking away from dollars and they're putting their money where my mouth is, and they're buying gold and silver. So this shows you that what Trump is trying to sell you and what the Federal Reserve is trying to con you into believing are not true.
Gold and silver don't surge like this when inflation is truly under control. That's the blunt point Peter Schiff makes as investors continue to pile into hard assets. He argues that the price action itself is proof people don't buy the official narrative. If inflation were really dead, as politicians like to claim, we wouldn't see this kind of move out of dollars and into precious metals. What investors are signaling is simple: they expect more inflation ahead, not less. Schiff points to the Fed's own preferred gauge, the PCE index, which rose 0.3% in August versus 0.2% the prior month. On a year-over-year basis, it edged up from 2.6% to 2.7%. That may look like a minor change, but the direction matters. It's creeping higher, not falling. Meanwhile, the Fed insists its goal is 2%, yet it has already started cutting rates. To Schiff, that's a glaring contradiction, loosening policy while inflation drifts further above target. If the Fed were serious, Schiff says it would be hiking rates. But the reason it won't is obvious. Higher rates would pop asset markets and expose the real fragility in the economy. Even the labor market, often touted as solid, shows cracks. The headline unemployment figure looks fine, but broader measures like U6 are already above 8%. In Schiff's view, the Fed knows the job market isn't as strong as advertised. That's why it's easing in the face of rising inflation, a gamble that gold and silver buyers aren't willing to trust. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
Gold closed today at about 3,760. It sold off towards the end of the day. It was above 3780 going into the last hour. We kind of sold off at the back end of the day. But, the absolute high, though, was set on Tuesday. So gold hit its all-time record high earlier in the week on Tuesday. It didn't quite get up there today. It almost hit 3,800. It came less than $10, maybe even less than $5 from 3,800. Silver, however, just kept on chugging along, making new highs pretty much every day of the week. It closed this week above $46. And it traded intraday a new high going back for about, 14 years or so. It got to 46.50 and change on the day. Here are the numbers so far on gold and silver. Gold up about 0.5% on the day, 2.2% on the week, 9% so far in September, and 43% this year. Not for a year, but so far in 2025. Silver doing even better, up about 2% today, 8% on the week. 8% in 1 week, 17% in the month of September, and 59% so far for the year. 59%. Now, of course, I don't talk as much about the other precious metals, platinum and palladium, although I have been talking about platinum a little bit more over the past year. In fact, I came out on this podcast, if you recall, when gold was above 3,000 and platinum was below 1,000, and I made a strong pitch that my listeners go to Schiff Gold and buy platinum, because I thought it was ridiculous that you could buy 3 ounces of platinum with a single ounce of gold. Platinum was up 3.3% today. It's up 12% this week, 19% on the month, and 74% year to date. 74. Palladium also not quite as good, but inching out gold. Palladium up 44% on on the year. Now, these are not normal gains. And it's not like these gains are happening, at least for gold, at depressed levels, because we started the year at record highs. And now we're just adding to those record highs. Yes, I think platinum and silver were depressed in relation to gold, not necessarily in relation to their own history. Although silver, at $30 or wherever it was at the beginning of the year, was still cheap compared to where it had been in the past, but it wasn't anywhere near a record. Gold was at a record, and now it keeps setting new records. But this would not be happening if inflation were well contained. Right? If we really were headed back to 2% in 2 years, like the Fed claims, if inflation hadn't been beaten into submission the way Donald Trump claims, every time he gives a speech now, whether it's at the UN or whether it's at Charlie Kirk's funeral, he talks about how inflation is dead and buried, right? How we've got the hottest economy in the world, it's the greatest economy in the world, and we've got no inflation. Well, if we really had no inflation, gold would not be doing this. Silver would not be doing this. So these are real world market indicators that there's a problem here, right? And that is inflation. These are inflation hedges. These precious metals are very sensitive to inflation expectations. People expect more inflation, they buy more gold and silver. So that's people voting with their feet, right? They're walking away from dollars and they're putting their money where my mouth is, and they're buying gold and silver. So this shows you that what Trump is trying to sell you and what the Federal Reserve is trying to con you into believing are not true. We got the personal income and spending numbers for August, and they pretty much came out right in line with expectations. So I don't know that there was any movement in the market that was necessarily affected by it. I mean, maybe the market went up because it wasn't worse than expected, right? Because everybody's always bracing for the inflation news to be worse than expected. But even though it was as expected, it's still bad, right? Personal income was up 0.4 on the month, and spending was up 0.6, which was actually a little hotter than expected on the income and spending side. But on the price stuff, right? The PCE, personal consumption expenditure. Now, this is the Fed's favorite index, right? And I think it's their favorite because it's the lowest, right? But the PCE on the month was up 0.3, which was expected. But that's worse than the prior month, which was 0.2. Year over year, up 2.7%. The rear view mirror was up 2.6. Now, yes, everybody expected it to go up to 2.7, but it went up. It's not going down. Why is the Fed cutting? Its favorite inflation measure is moving further above its 2% target. So why are they cutting rates? Why are they saying they're going to have more rate cuts? And it's worse when you look at the core, because apparently the core is the one they think is the most important. And the core was up 0.2, which was a little bit less than 0.3 from the prior month. But year over year, the core is up 2.9, the exact same as the month before. 2.9, it's almost 3. You're 50% above your target. Why the hell are you cutting rates? I was listening to this discussion on television today, and people were acknowledging, they were saying, well, we don't really need these rate cuts, right? Because we have this strong economy, and we got low unemployment, and we got a record stock market. So we don't really need the rate cuts. Well, we only need them if you want to prevent the stock market from crashing, if you want to prevent the economy from imploding, because the only reason it's not is because these rate cuts are coming. So you may not think we need them. It's only because we're getting them that the stock market is at a record. You can't say, oh, look, we don't have to cut rates because the market's at a record high. If we weren't cutting rates, it wouldn't be. In fact, the Fed should be hiking rates. Shouldn't be. Not only should it not be cutting rates, it should be hiking rates. And then the market would crash. Right? So with the economy, in fact, the economy is already weak. When they keep talking about the low unemployment number, that's all BS. Unemployment is high. The numbers aren't accurate. That's the problem. But even some of the numbers, like the U6 number at almost 8% or 8.1 or whatever, I think it's over 8%. It's high unemployment.
Peter Schiff argues that Wall Street has finally admitted what gold bugs have been saying for years. Inflation isn't going back to 2% and bonds are a terrible hedge when inflation runs hot. Bonds, he notes, get crushed as purchasing power erodes, while gold has always acted as protection. For decades, recommending gold made you an outlier among big firms. That's no longer the case. Morgan Stanley has now openly told its clients to buy gold, signaling a major shift in institutional thinking. The implications are huge. If firms start advising clients to cut their bond allocations, say from 40% down to 20%, that means an enormous amount of bonds, including treasuries, will hit the market. And this comes at a time when the US government is already struggling to sell record levels of new debt. The flip side is that much of that capital is being reallocated into gold and mining stocks, creating powerful new demand flows. Schiff emphasizes that this isn't some minor adjustment. Wall Street operates like a herd. Nobody wanted to be first to recommend gold because it carried reputational risk if it lagged. But once a giant like Morgan Stanley makes the call, others will follow. As long as gold prices keep climbing, no advisor can afford to sit on the sidelines. That dynamic builds on itself, fueling even stronger gains. Let's get back to the interview.
Morgan Stanley came out and tweaked the 60-40 portfolio. Now, this is a Wall Street, bellwether portfolio. 60% stocks, 40% bonds, right? I mean, that's it. That's the portfolio. They tweak it a little bit. If you're really young, they might say, look, go 80% stocks and go 20% bonds. And if you're older, maybe go 60% bonds, 40% stocks, right? They tweak it depending on where you are, towards your retirement goals. But that's been the portfolio ever since I've been in this business. I got my license in 1987, coincidentally, the year the stock market crashed. That's when I became a stockbroker, the year the stock market crashed. So I didn't really enter the industry at the best time. Although in hindsight, it was a great time to buy, but it was, a difficult time because a lot of stockbrokers, were waiting tables, right? They lost their jobs because of the 87 stock market crash. But that's when I got into the business. But ever since then, it's been 60-40, right? Morgan Stanley said, you know what? We need to split that 40% that was in bonds 50-50 with gold. So Morgan Stanley came out and said, our portfolio is 60-20-20, 60% stocks, 20% bonds, and 20% gold. Unbelievable. Now, it's about time. And the reason that Morgan Stanley is doing this is they're saying that we need an inflation hedge. And since stocks can also be viewed as an inflation hedge, although not all stocks are the same in that respect, but bonds are clearly the biggest victims of inflation, right? If you own bonds, inflation kills you. There is no hedge. And so Morgan Stanley said, look, we're going to have high inflation. Forget about 2%. That's old news. That's never happening again. And we're going to have high inflation. That's obvious. And so our clients need to hedge their bonds. So they need to buy gold. This is big. Not only is this a sell signal for bonds, because if you're a Morgan Stanley client and you got 40% of your portfolio in bonds and your advisor says, well, you got to go down to 20%, how do you do that? You got to sell half your bonds, right? It's a sell signal on bonds. A lot of those bonds are treasuries. So you have brokerage firms telling their clients to sell treasuries when the U.S. government has a record amount of treasuries that it needs to sell, right? Houston, we got a big problem here. But all the money coming out of bonds is going into gold. Now, again, the first time in my career as a stockbroker, major firms are recommending gold. Now, of course, I've been recommending gold the whole time. When gold was under $300 and I got my stockbroker license, I would tell people to buy gold, right? I was, the odd man out. Now, I'm still kind of the odd man, but I've got some company because it's just starting. Right? This trend is going to envelop all of Wall Street, right? It's like a herd, right? People are afraid to go out on a limb, right? Nobody wants to be the first one to buy gold because then if it goes down, you look like a fool. Hey, why'd you buy that? Why'd you put my money in that rock? Why'd you buy these gold stocks, right? You're fired, right? People are afraid, right? But once somebody else does it and it works, and then somebody else does it and it works, now you got to do it. Because now, if gold goes up, and it will go up, and the mining stocks go up, and you don't own them, Now your clients are going to say, hey, why didn't you have me in any gold? Why didn't you have me in any gold stocks? You're fired, right? So now the pressure is to put him in. So that's why I think we're going to see a massive run up between now and the end of the year, and probably between now and the end of the decade, as more people jump into the water, right? Because other people are there and they're swimming and they're having a great time, and you don't even have to, put your toe in. You could just jump right in now because everything is great. So this is what's going to happen, right? People need inflation hedges. Gold is now shown itself to be the inflation hedge. It's no longer going sideways, even though it never really was. I mean, it's way outperforming. The U.S. stock market is down 70% priced in gold in the last 25 years. And in fact, when you hear the financial news keep talking about Dow making a record high, no, it's not. It keeps going down. Year to date, the Dow is down, I don't know what, over 20, 25% this year. The Dow is getting killed in terms of real money, eviscerated. But you don't know that if you price it in funny money. And that's one of the reasons why Donald Trump wants inflation, so he can make it look like the stock market is going up, even though it's actually going down. See, everybody can feel richer because of inflation, even though they're getting poorer. Now, of course, if you don't have financial assets, you don't feel richer. You just are getting poorer, and you know it. And that's why a lot of people voted for Trump, because they were getting poorer. The problem is they're going to get even poorer now that they voted for Trump, right? Because all the problems they thought Trump was going to solve, he's going to make worse. And I'm going to get to that in a little bit. I want to continue talking about gold. But so you've got now Wall Street for the first time recommending gold stocks. So there's not going to be any big pullbacks. You just got to buy gold and silver, because now we've got a lot of company. It's not just Peter Schiff's fans and a few other gold bugs that want to buy gold and silver, right? We got a lot of other people that want to buy, and there's not that much of it. The same thing with mining stocks. The GDX hit a new record high this week, not today, but earlier in the week. But it's up 120% on the year, 18% so far this month. 1 month. 1 month, the GDX is up more than the S&P was up all year. The GDXJ up 20% during the month of September. Again, we got 2 more days to be up. It's up 125% on the year. Now, Wall Street is not going to allow this to go unnoticed, especially, as it's getting close to the end of the year. These are the best performing stocks, and they're still cheap. These tech stocks that people are buying are expensive, and they're losing a ton of money, right? Money-losing stocks. People are buying. Gold companies are making a killing. They have huge earnings. The earnings are growing. So there's a lot of value here, but we also have momentum. So you have momentum and you have value. See, the tech stocks, they just have momentum, right? And that could collapse at any moment. But you've got a solid fundamental foundation behind what's happening in precious metals. So this is just going to continue. Next year could be even better than this year, even though this year is spectacular. But you got to buy, right? You can't just procrastinate anymore. You got to go to Schiff Gold, buy gold and silver. Don't forget, buy some platinum. It's still got a lot of upside. You had Stephen Moran, who was the president's economic advisor, who's now sitting on the FOMC, right, as an insider for Trump. He was asked about the dollar, and he said, well, the Fed doesn't have a mandate on a strong dollar or any mandate on the dollar, right? We just have a mandate on price stability, right? Well, you're not going to have stable prices if you don't have a stable dollar, because stable prices are about the purchasing power of the dollar. But if you have someone on the Fed saying, hey, we don't care about the dollar's value, what does that mean? Dollar's going down, right? And if they don't care about the value of the dollar, they're not going to achieve their inflation mandate, because all inflation is a reflection of the purchasing power of the dollar. Now, maybe he was talking about just the exchange rate, but if the dollar buys fewer euros or fewer pounds or fewer any other currency, then everything that we import is going to be more expensive.
Striking shifts are unfolding in real time as both investors and institutions move in lockstep toward the same conclusion. The story of inflation is far from finished, and the traditional safe haven of government debt no longer carries the same trust it once did. The momentum into precious metals is less about chasing quick profits and more about rejecting the official storyline that rising prices are under control. What's emerging is a generational reallocation of capital, where gold is no longer a fringe idea but a core holding even for the most conservative portfolios. That change reflects a deeper recognition that monetary policy, political decisions, and economic data no longer line up the way they used to, and investors are voting with their dollars. Does this growing pivot toward gold signal the beginning of a long-term reordering of where global wealth is stored and protected? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.